Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings so you don't have to. Today, we're cracking open a semi-annual report for EA Series Trust, and trust me, it's more exciting than it sounds, especially if you like knowing how your money is being handled. Think of it as financial yoga, stretching those dollars. We're zeroing in on two exchange-traded funds, or ETFs, the EA Bridgeway Blue Chip ETF, ticker symbol BBLU, and the EA Bridgeway Omni Small Cap Value ETF with the catchy ticker BSVO. These reports are like a health checkup for your investments, telling you what's been happening over the last 6 months. Let's kick things off with a quick summary. For the 6 months ending in December, these ETFs have been navigating the market, some more successfully than others. We'll look at how they've performed, what it costs to run them, and what factors influence their returns. First, let's talk about expenses. For the EA Bridgeway Blue Chip ETF, if you had a hypothetical $10,000 invested, it would have cost you about $8 to keep it going during the period, or 0.15%. These are the fees you pay to have professionals manage your money. Now for the real juice, performance. Over the past year, the EA Bridgeway Blue Chip ETF had a return of over 27%. That's pretty solid. When looking back further, we see over the last 5 years, their annual return was around 15%, and over the last 10 years, it was just over 13%. So what made this fund tick? It looks like the fund benefited from its focus on mega-cap stocks, which are the really big companies, because they did pretty well compared to smaller companies during the reporting period. As of the end of December, the fund had around $225 million in net assets, spread across 38 different investments. Also, the portfolio turnover rate was 6%. This tells us how frequently the fund is buying and selling assets. What are the top investments? Let's jump to their statement of holdings. Top sectors include information technology, which is about 25% of the portfolio, financials almost 18%, and communication services at about 14%. Biggest positions include companies like JP Morgan Chase, Meta also known as Facebook, and Broadcom, each making up around 4% of the fund. Now let's switch gears to the EA Bridgeway Omni Small Cap Value ETF. This fund is focused on smaller companies that are considered undervalued. It costs around $24 for a hypothetical $10,000 investment, which translates to 0.45%. These are the expenses you incur for investing in the fund. This smaller cap value fund has not had as great of returns as the mega cap fund. Over the past year, it returned 4.75%, but over the last 5 years, it was around 11%, and the last 10 years, it was about 8%. The smaller companies in this fund didn't do as well as the bigger ones, which lowered returns, but a focus on smaller companies actually helped returns. At the end of December, this fund held nearly $1.5 billion in net assets across 604 different holdings. The portfolio turnover rate was a low 3%. This shows BSVO doesn't change positions often. Where is that money invested? The schedule of investments indicates that most of the fund's assets are in financials, about 33%. Industrials make up 15%, and energy makes up about 13%. The largest individual holdings include Telephone and Data Systems and Crescent Energy, around 1% of holdings each. I've skimmed the schedule of investments, but let's move on to something else for now to keep it interesting. An important part of these reports are the controls and procedures. The top officers of the EA Series Trust confirmed that their systems for managing financial information are effective and that there were no significant changes that could mess things up. Basically, they're saying they have the systems in place to make sure the financial information is correct. Finally, the report includes certifications from the company's president and treasurer. This means they're taking responsibility for the accuracy of the report. It's like saying, "We swear this is all true and correct." There is a lot in these reports, so make sure you check them yourself. Don't base your financial decisions solely on this overview. Alright, now it's time for my take. When you look at these funds side by side, you can see a really interesting picture of market strategies. The Blue Chip ETF is your steady Eddie, betting on the big names and delivering consistent returns. It's for investors looking for a safe ride on established routes. On the other hand, the Omni Small Cap Value ETF is swinging for the fences, trying to find the undervalued gems among smaller companies. It has had higher returns in the past, but in this time period it underperformed compared to the Blue Chip Fund. This is for investors willing to take on more risk for potentially higher growth. One thing that stands out is the expense ratios, which are actually quite low for both funds. This is important because high fees can really eat into your returns over time. One thing to be aware of, especially for BSVO, is its investments in smaller companies can be riskier and more volatile than those in mega caps, which may mean the road could be bumpy. Wrapping things up, EA Series Trust seems to be following a clear, strategic path with these ETFs, providing options for different investment styles and risk tolerances. For the blue chip ETF, its focus on big tech stocks looks like a winning strategy right now, but it also means it is tied to the success of a small number of firms. For the small cap value ETF, it's a bit more of a mixed bag. It requires a lot more digging to find the few companies that turn into big players. Thanks for watching Corporate Decoder. I hope I've helped you decode some of the complexities of this corporate filing. If you found this helpful, give it a like, drop a comment, and definitely subscribe for more deep dives into the world of finance. Until next time, stay informed and keep those investments working hard.